Welcome back to the Deep Dive. Today we are unpacking one of the great market puzzles of this quarter.
It's a really interesting one.
We're looking at Five9's Q3 2025 earnings call. And this is a classic case, isn't it? A company does everything right on execution.
Beats expectations on profit, hits record margins.
And the stock gets hammered. It dropped almost 8% the next day on like 4 times the usual trading volume.
It's a textbook disconnect. Management puts up the numbers, shows real control over the business, but the market was focused on something else entirely.
Exactly. So our mission today is to dig into that. We're going to look past the headline numbers and try to understand what anxieties the market is actually pricing in.
Right. It's all about the tension between their great financial discipline and this real skepticism about their growth.
And when all that incredible AI booking they're talking about will actually, show up as cash in the bank.
Yeah.
It's a lag story, and it's causing some real chaos.
So let's start with that snapshot of the quarter, because financially it was, on paper, a huge success story.
Yeah, let's set the table.
Non-GAAP earnings per share, they came in at 78 cents.
Which was a clean beat over the street, right?
A clean beat. The consensus was around 73 cents. Revenue was $285.8 million. Also a slight beat over the $285.1 million consensus.
And the really big one, for me anyway, was that this was the quarter they finally decisively flipped to being GAAP profitable.
Precisely. They reported 21 cents of GAAP EPS, which is a huge swing from a loss the prior year. But the real headline, the one management really hung their hat on,
The margins.
the margin expansion. Adjusted EBITDA hit a record 25.1% margin. That is a phenomenal 530 basis point improvement year over year.
530 basis points. That is just enormous in the software world. And that wasn't an accident, was it?
Oh, not at all. This is the direct result of those, transformation initiatives they've been implementing all year.
The workforce reductions and getting a better handle on costs.
Exactly. They're achieving real sustainable operating leverage. And you can see it in the cash generation. Free cash flow hit $38.3 million. That's a 13% margin. And their stock-based comp, which has always been a concern for investors, dropped from around 17% of revenue last year to about 12% this quarter. The business is it's structurally healthier.
Okay, so we've got a fundamentally healthier, more profitable company.
Right.
Yet the stock tanks. So this tells me the market is looking right past that operational excellence and asking a really fundamental question about demand.
That's the one.
Can they still grow? Is this profitability just coming from cutting costs, or is there real new business coming in?
And the market's answer pretty clearly was skepticism. Total revenue growth was just 8% year over year.
Yeah, going from around 264 million to 286 million.
Yeah.
That's a big slowdown for what investors are used to. They were seeing high teens growth for a long time.
A very long time.
So let's unpack that slowdown. Management did point to some tough comparisons, which is fair.
It is. They noted that their single largest customer finished this multi-year ramp-up, and just that one thing created a 5 percentage point headwind for subscription growth.
Right, but those are the known headwinds.
Yeah.
I think what really worried people was the friction in some of their other segments.
Yeah, the unexpected stuff, like the decline in their commercial business. It was down in the teens year over year.
Now, that segment's only about 9% of total revenue, but the reasons they gave for the weakness, I think that added to the unease.
I agree. They pointed to 2 things. First, they basically underspent on marketing for that segment.
And second, they had a gap in their sales team because they promoted too many people up into the enterprise group.
Right. And they said they'll fix it in a couple of quarters, but it still hurt the numbers for this quarter.
And you could see a little bit of that struggle in the retention numbers too. Dollar-based retention dipped just a tiny bit, from 108% to 107%.
Still super healthy, but it's another data point that suggests, while their existing customers are sticky, finding that new growth is just proving a bit of a challenge right now.
Okay, so this is where the whole story really comes into conflict.
The AI story.
The AI story. Management spent a ton of time on the call talking about their success in AI. And on the adoption side, the metrics are absolutely stellar.
They're showing overwhelming momentum. Enterprise AI bookings up over 80% year over year.
80%.
And enterprise AI revenue grew 41% year over year. Crucially, it's now about 11% of their entire enterprise subscription revenue base.
So it's not a side project anymore.
No way. They said AI is attached to basically all of their new deals over $1 million in ARR. It's baked into their sales process now.
And we saw some amazing examples of them winning with the whole platform, too.
We did. That big card services deal for 3.7 million ARR, a hospital system for 2.7 million.
But the most important one, I thought, was that $3.5 million upsell to the global parcel delivery company.
Yes, because they explicitly replaced an external standalone AI point solution.
And that's the bull case right there. The integrated platform is beating the siloed, one-off tools. But, and this is the big but,
this is the critical question that defined the entire call.
if you have 80% plus bookings growth in AI, and you're winning these huge deals, why isn't this success story hitting the revenue line faster?
That is the conversion bottleneck. And analysts really press them on it. The answer reveals this new dynamic in their business.
Right. Historically, a cross-sell to an existing customer was pretty quick to roll out.
Super quick. But what management explained is that these huge install-based bookings, the ones driven by AI, they now have implementation cycles that look more like a brand new customer.
And why is that?
Because integrating AI into a massive contact center is incredibly complex. You're not just, plugging in a chatbot.
You're re-engineering the entire workflow.
Exactly. You're dealing with data security, regulatory sign-offs, integrating the AI agents with a dozen other systems. It's a huge lift.
So even for an existing customer like that parcel delivery company, moving to the integrated platform takes a ton of work.
A ton of work and a ton of time. And that means the revenue gets deferred.
So this new lag, this is the whole story.
It's the entire story. The meaningful revenue impact from all this amazing AI growth is now pushed out until the second half of 2026.
Wow.
This delay, this, 4-quarter gap of slower growth that investors have to sit through, that is the fundamental reason for the sell-off. The market believes the AI story. It just hates the timeline.
And that timeline skepticism got a huge boost from their immediate Q4 guidance, didn't it?
It did. The midpoint of their Q4 revenue guidance was about $297.7 million.
It's a little bit below the consensus of $300 million, but it was enough to solidify that caution.
For sure. But despite that soft revenue guide, they actually raised the bottom line guidance. Full year 2025 non-GAAP EPS was raised to a midpoint of $2.94.
So how are they doing that?
It's that strong operating leverage we talked about, plus the new $50 million accelerated share repurchase, the ASR.
Right, the buyback.
Management is basically using their free cash flow to buy back and retire 1.7 million shares before 2026 even starts.
So they're buffering the EPS number and trying to support the stock at these, what they believe are, depressed prices, all while trying to manage expectations for the next few quarters.
And they gave really aggressive visibility into 2026 to try and calm those nerves.
Yeah, what did they say exactly?
They were explicit. They said sequential revenue growth will be pretty much flat in Q1 of 2026. But then they expect double-digit year-over-year growth to return and return strongly in the back half of 2026 once those big AI projects finally start generating revenue.
So they're giving you a roadmap, but you have to be patient. You have to wait almost a year for the real payoff.
Exactly. They even confirmed they're comfortable with the 2026 street consensus of about $1.25 billion in revenue, and that they expect to beat the current EPS consensus of $3.14. It's a picture of a successful transition, but it's a lumpy one.
And if you connect this back to their bigger strategy, this call really highlighted a pivot, didn't it?
A major pivot. They're explicitly moving away from the old software playbook.
Which was the draw.
Growth at any cost? They're shifting from being a pure growth CES vendor to what they call a disciplined Rule of 40 platform company.
Okay, so let's explain that. CES is contact center as a service. It's their core business. But what's the Rule of 40 and why is that such a big deal?
So the Rule of 40 is a metric for more mature software companies. It just means your revenue growth rate percentage plus your adjusted EBITDA margin percentage should add up to 40 or more.
So they're trading some of that crazy top-line growth.
For a more balanced approach, they're targeting 10-15% revenue growth combined with, 25-30% plus EBITDA margins by 2027.
So they're telling investors, judge us less on hype and more on consistent, profitable cash generation.
Exactly. And that fundamentally changes how you value the stock. You move from a high revenue multiple to a higher cash flow multiple.
And the new $150 million share buyback, with that $50 million ASR already started, that really reinforces the new narrative. It shows they're confident in their cash generation.
Right. And all this is happening while the platform itself is getting stronger. The Acquion acquisition in 2024, the momentum with partners like ServiceNow and Salesforce, all these things make the platform stickier.
This all ties into the CEO's big picture narrative. about the market opportunity.
He framed it as AI expanding their total addressable market, their TAM. He argues the real prize isn't just the, $24 billion cloud CCaaS market.
The real prize, he says, is the much, much larger $210 billion contact center labor pool.
That's the pitch. That Five9 can use AI to automate or augment work across that entire human and AI spectrum, not just sell the tech.
Which is a huge story.
Yeah.
It connects to that analyst question about the on-premise market.
Yeah.
60% of companies are still on-prem.
Yeah, and management confirmed that companies are finally moving to the cloud specifically for the AI benefits. Sales cycles are becoming AI first. The need for AI is now pulling the core platform decision along with it.
So the thesis is that AI, while it's causing this temporary revenue lag, is actually the key to unlocking a far bigger market for them. But we still have to talk about the valuation tension.
It's a big one. Even after this deep sell-off, the stock is trading near the bottom of its 52-week range and is way underperforming the rest of the software sector.
And yet it still has a pretty demanding forward PE multiple, around 50x.
Which is way higher than some peers in the low 30s. Investors are clearly still assigning a big premium to that long-term AI story, but their patience is definitely being tested.
And at the same time, you have some third-party fair value estimates that are closer to like $34, $35 a share.
So that's the puzzle. Strong fundamentals, great long-term AI story.
Meeting very real investor skepticism over the next 3 quarters of slower growth.
Exactly.
Okay, that brings us to our final segment. This is not financial advice.
You know the drill.
This is strictly for informational and entertainment purposes. We are not recommending any specific actions. Any scenarios we discuss are hypothetical and, outrageous but plausible.
Okay, so with that out of the way, given the dramatic drop after an earnings beat, the market is pricing in all the immediate bad news, the slowdown, the flat Q1 26.
All of it.
But it seems to be heavily discounting 3 things: the guaranteed margin expansion, that $150 million buyback, and management's confirmed reacceleration in the second half of 2026.
And we saw options data spike after the report, right?
Right.
Specifically long-term call option volume, which suggests some speculative money is betting on that turnaround timeline.
So our outrageous but plausible pitch is a trade that bets directly on that 2026 inflection point.
A longer-term play.
A longer-term play. The idea would be to buy a long-dated call spread, so you'd buy calls that don't expire until 2027 when that rule of 40 commitment should be proven out.
You're leveraging the currently depressed stock price.
And betting that once that 80% in AI bookings finally converts to real revenue, the stock snacks back toward that $34, $35 fair value estimate. It's a bet on patience.
So to recap our deep dive then, Five9 is absolutely executing on the profitability side of the business. Record EBITDA, great free cash flow.
But the market is completely fixated on the near term. Sub-double-digit growth and that long delay before all this AI momentum shows up in the revenue line.
So the central question you have to ask yourself is this. Management says AI expands their market from $24 billion to $210 billion. Is that story and their commitment to the rule of 40 enough to justify waiting through 3 more quarters of slow growth?
Is it guaranteed enough to override all that investor fatigue we're seeing right now? That's the bet you have to make.
And that's the knowledge you get when you take the deep dive. Thank you for joining us.